You have $10,000 somewhere right now, maybe sitting in a basic savings account, maybe spread across a few apps you downloaded during some late night rabbit hole on the internet, maybe parked in your checking account because you genuinely have no idea what to do with it next. And here's the uncomfortable truth that almost nobody in your life is ever going to say to your face: that money is slowly dying. Not dramatically, not all at once, but quietly. Every single month, a little more of its value is being eaten away. The gap between where you are financially right now and where you could realistically be is growing wider. And most people will spend their entire lives never understanding why that gap exists. Now, before you get defensive, I need you to hear this clearly. It is not your fault. I mean that genuinely. The reason the majority of people do not know how to actually grow their money has nothing to do with intelligence. It has nothing to do with how hard they work. It has everything to do with the fact that the financial system was never designed to teach ordinary people how wealth actually gets built. It was designed to keep regular people just confused enough to stay dependent on products, fees, and services that benefit the system, not the individual sitting at home trying to figure it out. Confused people do not build wealth. They just keep working harder, spending more, stressing constantly, and wondering why the numbers never really seem to change no matter what they do. So today, I want to show you something that sounds almost too simple to take seriously. I'm going to walk you through exactly how $10,000, using the most hands-off and yes, genuinely lazy approach that exists in personal finance, can realistically grow into $400,000. No hot tips, no trading strategies, no side hustle grind, no 6-monitor setup. Just a clear, honest understanding of how money actually works when you stop getting in its way and let it do what it was designed to do. Let's get into it. Every week, without fail, some new video goes viral telling you exactly how to hustle your way to wealth. Wake up at 4 in the morning, stare at trading charts for 6 hours a day, learn option strategies, flip products online, start multiple businesses at once, grind until your eyes blur, and then grind some more tomorrow. And look, for a very small, very specific group of people, some version of that actually produces results. But for the overwhelming majority of regular people who try that path, what actually happens is exhaustion, confusion, costly mistakes, and eventually giving up completely. Most of them end up right back where they started, usually with less money and significantly more stress. Here's what those videos almost never talk about. The people who have quietly built the most lasting, most significant wealth, the kind that actually shifts a family's financial situation across generations. Most of them are not the ones glued to their screens watching every market tick. They're not the ones losing sleep over what some central bank said on a Tuesday. They found a simple, time-tested system. They put their money into it, and then they left it alone and went back to living their lives. They let time do the heavy lifting. They let a documented, proven process do exactly what it was built to do. And while everyone else was grinding, stressing, and chasing, these people were just living, while their money grew quietly in the background. That's the actual lazy way. And lazy here doesn't mean careless. It doesn't mean irresponsible. Lazy in this context means strategic. It means you stop overcomplicating something that was never supposed to be this complicated. It means you trust a system that has decades of real-world data behind it, and you resist the constant urge to interfere with it. Because in investing, doing less is almost always more. Now, let me describe you for a second. And I want you to be genuinely honest with yourself right now. You have watched a solid number of finance videos. You have notes somewhere, a notes app or a journal full of financial tips you wrote down with every intention of acting on and never did. You've had real conversations about getting serious with your money, maybe 2 or 3 times this year alone. You've Googled things like best investments for beginners at 11 at night when the motivation suddenly hit. And yet that $10,000 or whatever amount you have sitting somewhere right now is in the exact same place it was 6 months ago, possibly 12 months ago. If it's sitting in a regular savings account, here's what's actually happening to it right now. Most standard savings accounts pay around 1% interest annually. Meanwhile, inflation, meaning the rate at which everything you buy gets more expensive every year, runs at roughly 3 to 4%. That means in real terms, adjusted for what your money can actually purchase, you're losing ground every month without spending a single dollar. You're not even treading water. You're drifting backward without realizing it.
And the cycle that keeps people stuck is subtle but powerful. You keep watching content like this because watching feels productive. Learning feels like forward motion. But there's a massive difference between absorbing information and actually doing something with it. The longer you stay in pure consumption mode, the harder it becomes to shift into action. At some point, learning becomes a way to delay deciding, and every month you delay, the compounding clock that could be working for you keeps running without you. You already understand enough to start. What I'm about to show you is enough to genuinely change what your financial future looks like. So stay with me through this. Let's talk about the actual math. Because the math doesn't care about your feelings. It doesn't care if you're nervous. It doesn't care that you waited 2 years. It just works. And once you see it clearly, it becomes very difficult to argue with. The strategy behind taking $10,000 to $400,000 is built on exactly 3 things: investing in a broad, diversified, low-cost index fund, giving it time, and a force called compounding that most people think they understand but dramatically underestimate when they see it fully play out over decades. Here is what compounding means in the plainest possible language. Your money earns a return. That return gets added to your total balance. Then, in the next period, your money earns a return on the new, larger balance, including all the earnings from before. It's money making money on the money it already made. And the longer you let that process run without touching it, the more powerful and dramatic the growth becomes. The first few years feel almost invisible. The final years feel almost unbelievable. Now, let's use real historical data. The S&P 500 is essentially a collection of the 500 largest publicly traded companies in the United States, spread across every major industry. When you invest in a low-cost index fund that tracks it, you're buying a tiny piece of all of them simultaneously. Historically, over the past 5 decades, this index has averaged roughly 10% in annual returns. Some years it runs up 25%. Some years it drops 15%. But averaged across long stretches of time, the number lands around 10%. And that's what we're using here, and it's the most honest long-term figure we have available. Here is what $10,000 looks like when you apply that average and do absolutely nothing else. After 10 years, your $10,000 becomes approximately $26,000. You didn't call anyone, you didn't monitor anything, you just left it. After 20 years, that balance grows to around $67,000, still just sitting there. After 30 years, you're looking at roughly $175,000. And at 35 years, your original $10,000 has grown to over $400,000. One decision, one action, time did everything else. Now, some of you are already thinking that 35 years is a long time. And you're right, it is a long time. But here's the reframe that actually matters. Those 35 years are going to pass no matter what you do with your money. The only question is whether your money is compounding quietly in the background during that time or slowly losing purchasing power while you wait to feel ready. And if you layer in even small, consistent monthly contributions on top of that initial $10,000, the final numbers grow to something considerably larger. The math isn't magic. It's not a trick. It's just what happens when you stop interrupting a process that actually works.
Now, here is where most people start quietly losing faith. Not because the strategy stops working, but because this is where the emotional side of investing begins to show up, and nobody really prepares you for that part. At some point during the time your money's growing, the market is going to drop. I am not speculating about this. It is a certainty. Sometimes by 10%, sometimes by 20%, sometimes during a serious economic downturn by 30% over several months. And when you open your app and see that what was $30,000 has dropped to $22,000, every instinct you have developed as a human being is going to scream at you to do something. Pull it out, protect what is left, wait for things to stabilize before putting it back. That reaction is completely human, it is completely understandable, and it is responsible for destroying more long-term wealth than almost any other single factor in the investing world. Here's why. When you panic and sell during a market downturn, you turn a temporary paper loss into a permanent, locked-in real loss. The market then begins to recover because historically it always has. But now you are on the sidelines watching it go back up. When do most people get back in? When things feel safer and more stable again, which almost always means prices are already significantly higher than where you sold. You sold low, you bought back in high.
And that one emotional decision could cost you far more in long-term growth than the original drop ever would have. The patient investor understands this moment completely differently. When the market drops, they aren't losing money unless they actually sell. They still own the exact same number of shares in all of those companies. The businesses have not disappeared. The economy has not permanently collapsed. In historical terms, the drop is not a disaster. It's a discount. And the only people who experience it as a permanent loss are the ones who exit before the recovery. So, when the market falls and your gut says act, the lazy strategy says do exactly nothing. Close the app. Do not look at it for a month. Go live your life. Because the most costly financial decisions most people ever make happen in moments of fear, not in moments of calm. I also want to be completely transparent with you about something that a lot of finance content online tends to gloss over, and that I think you deserve to hear honestly. This is not a get-rich-quick strategy. 35 years is not quick by any definition. There will be years where your balance grows fast and everything feels exciting and right. There will also be years where practically nothing seems to happen, where the number barely moves and your patience gets tested in a way you didn't fully anticipate when you started. There will be people around you talking about some new opportunity that sounds significantly more exciting than your boring index fund sitting untouched in a brokerage account. And in those moments, this strategy is going to ask you to do something that feels deeply uncomfortable. It's going to ask you to do nothing at all. That's genuinely the hardest part. Not picking the fund, not setting up the account. The hardest part is the years of quiet discipline it takes to keep your hands off of something that's working exactly as it's supposed to. And I want to speak directly to you for a moment about your past, because I think it matters. If you've made financial mistakes before, and nearly everyone has, I need you to hear this clearly. It doesn't matter. Whatever happened with money before today has zero bearing on what is possible starting right now. The market has no memory of your past decisions. It holds no grudges. It doesn't reward people who deserve it and punish people who made mistakes. It simply grows over time for whoever shows up with consistency and patience, regardless of when they started or what they did before they got there. If you spent money last year that you wish you had invested, that chapter is finished. If you tried something that went wrong, that chapter is finished. If you're starting later than you planned, starting late is infinitely better than starting never. The best time to begin is always the moment you actually decide to, not when conditions feel perfect, not next month when things settle down. Now, one more thing I want you to sit with before we close this out. The biggest threat to this entire strategy is not a recession, it's not a stock market crash, it's not a slow economy or a bad stretch of years. The biggest threat is the version of you that gets bored or frightened or tempted by something shinier 6 years in and decides to abandon the system right before it enters the most explosive phase of its growth. Compounding does its most dramatic work in the final years. The difference between 30 years and 35 years is not simply 5 more years of modest growth. It's more than double the total outcome. The last phase is where the majority of that $400,000 actually comes from. The people who walk away early, who redirect the money, cash out or switch strategies after doing all the hard years, and then leave right before the payoff. Please do not let that be you. Here's where I land with you, and I want to be completely honest about this last part. 99% of the people who just watched everything in this video are going to do nothing with it. Not because they disagree, not because the math doesn't make sense to them, but because taking real action requires making an actual decision, and making a decision requires commitment, and commitment means no more hiding behind the comfort of still researching. It means picking a direction and moving. So, most people will close this video, go back to scrolling, tell themselves they'll start when the timing is better, and 6 months from now, they'll stumble across something similar and feel that same mix of motivation and paralysis all over again. The cycle repeats, the money stays where it is, and the compounding clock, the most powerful financial tool available to ordinary people without connections or special knowledge, keeps running without them. The 1% who actually do something with this information, who don't wait for perfect conditions, who don't spend another 6 months researching before they feel fully ready, who simply start with whatever they have available right now, Those are the people who will look back in 20 or 30 years and understand exactly why their financial situation looks completely different from almost everyone around them. It won't be because they were smarter. It won't be because they got lucky or had better timing. It will be because they made one decision and had the discipline to protect it. So, the only question left is which group you're going to be in. If you're serious about taking this further, specifically how to identify the right type of account that lets the government take the smallest possible cut of your gains, how to structure this if you're starting with less than $10,000, and what the actual next practical step looks like right now, that's exactly what the next video on your screen covers. Watch it right now while you are still in this mindset. Don't let the momentum fade. Click it now.